Hello and welcome back to the Dividend Experiment, the channel that can help you build a portfolio that pays your bills. In today's video I'm going to give you a short guide to dividend investing for beginners. Investing in dividend paying companies is a fantastic way to generate passive income, as we've talked about before, and grow your investment portfolio over the long run, or over substantial periods of time. By focusing on strong, solid companies that regularly increase their dividends, a small sum of money could grow into something significant due to the power of compounded gains. If you're looking for the exciting, life on the edge, yacht or bust type of investing with high risks and high rewards, it may not be for you, but it is perfect for those interested in retiring early or just want to supplement their income with a reliable source of income. In this video, I will cover the important things to know before you start building your dividend income portfolio. So why invest in dividend paying companies? I've already covered what dividends are in another video entitled What is a Dividend? So if you are uncertain what they are, then first go and check out that video. Dividends are the only way in which you can actually get money from the profits of a company you have invested in without selling your shares. One way to look at it is that if you are a farmer with a cow, you can get value from the cow by killing it and selling the meat. And this will give you a lot of money right now, but you don't have the cow anymore. Alternatively, you could milk the cow. You wouldn't get as much money as killing the cow and selling all the different parts of it. But if you wait long enough, you could milk it again for more money. Using this analogy, we see that dividend investing is probably not going to get you super rich super fast. But instead you can get rich, just slowly. If a company is giving out dividends, it tends to be bigger and more mature. So they won't skyrocket in value, but will have a stable cash flow that will hopefully continue to pay out for many years. And these dividends will help us grow our portfolio over time. Be careful of the yield. You can tell how much money a company will give its shareholders by looking at the dividend yield. It is a percentage of the share price that will get returned to you if you hold it for long enough. Let's take a look at this example. It's Apple stock, and as you can see, it has a current yield of 1.46%. So if you bought this stock right now, assuming it doesn't change the dividend, you will receive 1.46% every year. Sometimes new investors learn this and fall into the trap of thinking they should just search for companies that pay the highest dividends. So let's take a look and see if we can find a high-paying dividend stock. Okay, here we go. It's the online trading platform Plus 500. With a massive dividend yield of almost 30%, it seems like this would be a great investment. You only need to wait just over 3 years to get back your original purchase cost. Then after that, everything is essentially free money. But looking at these sky-high yields, it has a high chance of being a trap. Plus 500 is actually a good example. So let's look at the share price over the last year. As you can see from the chart, there was a major collapse in share price in early February. A reason for this is that the European government and lawmakers have clamped down on highly leveraged trades, which was a big part of Plus 500's business model. With its revenues falling by such a dramatic degree, it's unlikely that Plus 500 will be able to continue paying a dividend at this same level. It may just reduce it, or it may cut it completely. Avoid the dividend yield trap and make sure you do plenty of research before deciding on your dividend payer. What should I look at when doing research? The more research the better, but here are some metrics that you should probably be checking out at the very least when deciding to buy dividend stocks. Firstly, just as we just talked about, the yield. It's not the most important thing, but it is good to see how much you can roughly expect if you invest in the company. It's also good to see if the company regularly increases the dividend, to see if your yield on cost will grow over time. The payout ratio. How much of the profit is being paid out as dividends? In order for a company to grow, it should spend some money on research and development and expansion. If it's spending too much on giving out dividends, it may not be able to grow the company in the future. If profits drop, then a company with high payout ratio may not be able to continue paying the dividend at the same rate in the future too. EPS growth. Are profits per share increasing over time? You probably want to invest in a company that will make more money in the future, rather than one that's losing money. The PE ratio. When a company matures, it can be measured with a PE ratio. I made a video about the PE ratio, so if you're unsure what it is, then definitely check out that video. And total return. This is simply the dividend percentage that you have gained, as well as the capital gains added on too. One good thing about dividend companies is that they still have potential to grow on top of paying out your dividends. When do I get paid? The important part of being a dividend investor is, naturally, getting paid. So, when do we get paid? There are 5 important dates you need to bear in mind. Number 1, the trade date. This is the date you put in the order to buy the shares. Number 2, the settlement date. This is the date the shares actually enter your possession. You don't necessarily own the stocks the day you paid for them. It can sometimes take some time for the details and paperwork to settle. Number 3, the ex-dividend date. This is the first day a stock trades without its dividend. If you buy shares before the ex-dividend date, you're entitled to that dividend payment. If you purchase the shares on or after this date, you won't get paid until the next dividend cycle. Number 4 is the record date. This is the date where the company decides who gets the dividend or not. It depends on whether you completed the trade before or after the ex-dividend date. And number 5, everyone's favourite, the pay date. This is when the dividends get paid out to you. In conclusion, this has been a very basic introduction to dividend investing. If there's anything else you want to know, then please leave a comment below and I might be able to answer it, or even make a video on it later. If you think dividend investing is the way forward, then please feel free to follow along by subscribing. Thanks for watching, and I hope to see you on the next video. See ya!